Life cycle costing is the approach companies now use to understand and manage all costs incurred in product design and development through manufacturing, marketing, distribution, maintenance, service, and finally, disposal. Managing life cycle costs is also known as managing costs from the cradle to the grave. To better explain life cycle costing, let's take a look at three different types of light bulbs. On the left is a light-emitting diode, also known as a LED. In the middle is a compact fluorescent light bulb, also known as a CFL. And on the right is an incandescent light bulb. Okay, so let's say a light burned out in your house and you need to go to the store to buy a new one. Once you get there, you see that the incandescent bulbs are rather cheap, about $1.50 in this example. CFLs run you about twice as much, around $3, and LEDs can run 10 times the amount of CFL bulbs, about $30. Now, while at first it seems that the most obvious choice would be to choose an incandescent bulb, you can see that the life cycle cost of each bulb is very different, and this is because of the varied wattage between each bulb. LEDs and CFLs are much more efficient than incandescent bulbs, meaning for a lot less wattage they can produce the same amount of lumens, or light. Because LEDs and CFLs use so few watts to produce the same amount of light, the price of electricity per kilowatt hour is much less for LEDs and CFLs. Therefore, the cost to light your home with an incandescent bulb can cost you $900 for 50,000 hours, and for a CFL about $210, and for an LED only about $90. Not to mention you would need to buy 33 incandescent bulbs because of their short lifespan, and 5 CFL bulbs, and then only 1 LED bulb. By buying a more efficient bulb, you'll not only save money replacing these bulbs, but you also save a lot of time changing out each bulb. Not to mention, 33 incandescent bulbs take up a lot more space in our landfill than 5 CFL bulbs or 1 LED bulb. Life cycle cost assessments are important because they not only save us time and money, but also can help reduce the amount of waste that we create. This light bulb example explains why looking at the life cycle costs of the material choices that we make are very important. In management accounting, the life cycle costing method spreads the expense of an asset out evenly over several years. This method has several advantages and disadvantages. The disadvantages to this method are that it could be very time-consuming to assess the life cycle costs of a product, or for all of a business's assets. Plus, the life cycle costing concept assumes an asset will be productive in later years as if it were new, which may not be the case. If a piece of equipment, for example, gradually slows down, you'll be earning less income from it than expected, which will affect the assessed value of the equipment. If an LED bulb malfunctions or breaks, you're out another $30, as we discussed in our previous example. However, there are many advantages to life cycle cost assessments. Life cycle cost assessments result in earlier actions to lower costs, more accurate and realistic assessments of revenues and costs, and therefore better decision making. It encourages businesses to find a correct balance between investment costs and operating expenses. The profitability of individual products can be better understood by properly assessing the life cycle costs of all products.